I'd like to welcome our panelists. We just heard an inspiring presentation by the head of the IMF and the fact that government agencies around the world and leadership of the World Bank, IMF, and many others have responded at an unprecedented level to support the world's economy, focused our attention on those areas of the world that need support more than others, making sure that when we come out of this, we have a more fair distribution of income, and we focused on the environment at the same time. So this session is entitled Capital Markets in a Time of Global Disruption. And we couldn't have better panelists with Lara, Scott, and Steve that are joining us today, and will give us all different perspectives. Maybe we'll start with yourself, Steve. Credit markets, equity markets seem to be giving us different messages at the same time, particularly in the US. The US has responded with responses we saw in Europe by the buying up of securities. What are your thoughts today?
First, Michael, thank you for having me here. It's great to be part of this. It's a great program. If you turn to slide 11, I get to be the first person to call up a slide.
Well, Stephen, some of your slides over the past few decades have made the Hall of Fame. So,
oh, good. I'm excited to see the Hall of Fame rolled out. But if you turn to page 11, you'll see that the high yield is about the top quartile. Within high yield, contrast that with, we were trying to think of a variety of ways to express the equity market. And whether it's looking back on PE or price to book or enterprise value to sales, a variety of measures would suggest that the equity markets are pretty fully priced and are embracing that this will be somewhat of a V recovery, also embracing some of the winners and the losers that Kristalina talked about in this recent market, whether it's Amazon and Netflix, et cetera, being the winners. Contrast that with debt, and particularly, I think high yield is probably the most fair expression of value. We're much more skeptical about the nature of the recovery. You might say, well, loans look like they're cheaper, but the loans of today are significantly riskier than the loans of prior decades. In fact, if you look at the percentage of double Bs in the loan index are lower than the double Bs in the high yield index, which was not the case in 2008. It was actually flip-flopped. So we think the debt markets are more skeptical about the recovery. Specifically in the debt markets, you can get, call it close to 400, a little bit over 400 for double Bs, which you're getting what we think is a pretty good loan to value, call it 30%, and getting a multiple over the risk-free rate suggests that there's a pretty good margin of safety in the debt markets, and certainly relatively to the equity markets. And in the absolute, that's historically been a decent place to be. So for double Bs. So we think it's really a tale of two cities.
So, Stephen, one of the things we've seen, if we reflect over a very long period of time, is usually the bond market, particularly in non-investment grade, leads the stock market. Here, we're seeing really for the first time the stock market lead the debt market. And one of the things that you particularly have focused on, and I know for GoldenTree took advantage in that 2008-2010 period, where the more complicated the securities, the greater the opportunity. Where do you see that opportunity today? As in a crisis, people generally move for simplicity.
Sure. I think that looking at RMBS market, particularly the legacy market, was a place of misunderstanding. So I wouldn't say these are terribly complicated securities, but because they behaved so poorly the last cycle, and they also were one of the few areas in the credit markets that had credit on credit. So basically people, particularly the mortgage REITs, were borrowing against their holdings in residential securities. And if you turn to page 12, or slide 12, would demonstrate that basically the value in the mortgages today is called about 35 to 40%, about 40% equity value in the loans of legacy securities. Securities issued before '08, they were previously subprime. However, back in 2008, there was only about 10% equity, so or 5% equity. So you were much more likely to not pay in '08 if you only had 10% equity and a lot of economic uncertainty. Didn't have contrast that with the current environment where you're starting with about 40% equity, and if you look at the equity relative to your annual payments, you have 9 times your annual. You have basically, if you have a 20,000, I guess, per year payment, and you have an equity value of around 180,000, you're going to feel pretty good about figuring out how to pay your mortgage, or certainly sell your home before you default. So we saw that these opportunities had gone from basically 95 cents on the dollar to around 50 cents on the dollar. And so that was something that we viewed as people were looking backwards to the last crisis of a place of an asset they didn't want to own relative to how much more creditworthy these securities have become over the last decade or 12 years. So that would be an example of something that we thought was a didn't make sense opportunity in the current environment. There were a few others, but that would probably jump off the page of a better situation versus the last cycle.
Thank you, Stephen. I'll come back. Laura, first, before you begin, I want to thank you and your firm for keeping financial markets open. You might even comment what you were thinking about at the time. Your firm has become a leader in trading of credit in the world, among other types of securities. On the other hand, during this crisis, you had a focus on your own employees around the world, and you had a slew of borrowers all over the world with varying response by industry, et cetera. And I do know one of the reasons that GoldenTree got so focused on RMBS was Credit Suisse. So you showed them the light.
Thank you.
Take us inside the management and the leadership of Credit Suisse as you think back over the last few months and today, how you look forward.
Oh, thank you very much, Mike. I really appreciate it. And I know we'll get around to it. Thank you for this forum. I know it's extraordinary times, but it's great to be here. Yeah, it's definitely been an interesting time. And I guess I would make a couple of just general points on top of what Kristalina made, which is, I think it's such a unique time to reestablish not only how we invest, but to reestablish the trust and the global collaboration that, frankly, I think had completely broken down, not only with the financial institutions, but also with governments. And so in terms of the early days of the crisis, a couple of those themes came forward for us very quickly. First of all, as you've discussed, the markets over the first few weeks were incredibly turbulent. We had a significant number of our clients come to us, as you would imagine, more on a defensive level, needing that much needed liquidity to get through what they found to be the potential for uncertain times. And what was interesting about that situation was, even though we're a Swiss-based organization, we obviously have very strong franchises around the globe. But we were extending credit in a number of different locations and liquidity. In essence, forcing a lot of our regulators to recognize that in a crisis like this, even though they'd like to keep everything ring-fenced, it's incredibly important that all banks can come to the aid of their clients no matter where they are. And as you know, as a Swiss institution, we are very well capitalized and have an incredible amount of liquidity. So for me, while the central banks were so important and there was such a strong amount of support provided, and I think if you call up slide 4, what was interesting and what we all know now is that this was done across the globe by all developed markets very, very quickly. But I think at the same time, what you also saw were the banks collaborating with those governments. And in fact, we were very proud at Credit Suisse to actually be one of the architects in Switzerland of what has turned out to be one of the most successful and fastest responses to the COVID situation in terms of our small medium enterprise facility, which I believe you've discussed on a previous panel with us before, where we basically worked with the Swiss government to extend up to $20 billion initially. That was then doubled to $40 billion to small medium enterprises, restaurants, hairdressers, etc. They could get that credit online literally in several minutes. So again, leveraging digital to get money to the organizations and clients that needed that very quickly. And as a result, I think the situation in Switzerland stabilized very quickly. So it's not just the traditional liquidity that obviously we all made available to our key corporate clients, but also some of, I think banks, again, are playing a very important role in working with governments, reestablishing the trust and our responsibility during this crisis to come up with new ways of getting help to our clients more quickly. So I think that's been very important. In terms of just credit in general, we're obviously in that phase of the crisis, I would argue, where many of our clients are actually looking to take advantage of the environment. And I do think that, as Kristalina mentioned, if you're in a weaker environment, you're looking to stabilize your balance sheet. If you're in a position of strength, you're looking to take advantage of your position. And so we are continuing to see clients either need to restart their businesses with additional liquidity, which I think is very important for the financial sector to think about. Again, round 1 was defensive. Round 2 now is offensive. How do we restart these companies, their supply chains, their working capital? So we're seeing a lot of that around the world. But again, also many of our clients looking to take advantage of what they see as dislocations or opportunities to invest. So I think from a credit perspective, we're very focused on being there for all of our clients, whether we're in Asia, whether we're in the United States, or whether we're in Europe, or in some of the emerging markets that Kristalina referenced, where we are right alongside the IMF, working with them very closely to invest in those situations. And then I think maybe just to give you some sense on the employee side, because I'm sure we'll talk about this, I think it was an unprecedented situation. We were able to get over 90+% of our employees not only able to work from home, but I think during an incredibly sensitive period, have done a lot to make sure our people are well taken care of, including providing antibody testing for everybody. But I do think that firms will structurally continue to think about a new balance, a new contract between their employees and the firm. And I think one of the most interesting things for me as we think about where industries will shift is, where are those new contracts rewritten? Where are those social contracts rewritten between banks, governments, and economies to basically recast how we operate going forward? And I do see, at least from a Credit Suisse perspective, we have begun to reestablish a very different relationship with our employees even through this crisis. It's something we will actually look to extend as we go forward. And so, I would say from a leadership perspective, I was certainly really proud of our organization as it had to really rethink its role within Switzerland, within many of the markets it's operated with its clients, to do things that are on very short notice and under very difficult conditions. I think life and death for some of these people, these clients, and these employees. So it's a fascinating time, and I think while I didn't know what Kristalina would said, I cannot agree more that we really are at a tipping point where the financial markets can make an incredible difference if we choose to in which direction, you know, the world goes. And that's certainly how we're thinking about it at Credit Suisse.
So Laura, a couple things. One, in talking to your employees that ran trading desks, had to raise capital for people, I think even they were amazed on how seamless it was that they could operate. When you think of the close proximity of your traders, sales, research groups on trading desk, that they could execute and communicate from a distance. Do you see that this will change how you operate in the future?
The short answer is absolutely. And I think what's interesting about what you're saying, Mike, is that for a firm like ours, who's in the wealth management business with incredible investment banking, our clients needed advice. I mean, never in recent history have we seen such influx of uncertainty, therefore need for high touch advice. And so in a way, you would expect that the pressure on that proximity would have meant that what we achieved would have been impossible without major damage to our client relationships. And in fact, we did not have that happen. And so we are absolutely thinking about whether there is a better way to have our employees, you know, work. We talk about work being something you do, not a place you go all the time. But I think that we have demonstrated that we can maintain our client relationships and the proximity and the benefits proximity brings without necessarily always being in close proximity to one another. And I think the dependency on good, strong technology tools, good relationships with our clients, you know, all of those things really came to bear during the crisis, but it's absolutely part of the strategic thinking going forward, that we will be reshifting our expectations for people and what coming to work really means.
Thank you, Scott. I think back to the financial crisis of 08, 10, and I think of your role in advising governments as to what they should be doing, and also the insight you had in many of the new securities that were created, such as Build America bonds. Take us back and contrast what you were talking to government about, say, in 08, 2010 period, and what you're been talking to government about in this year.
Well, Mike, I would say that the tone of the conversation has changed a great deal. And that is that unlike my experience back in 08 and through 10, you know, government was very wary of private sector involvement. They were suspicious of all, you know, ulterior motives and so on and so forth. Today, they're very anxious to hear ideas and they're very supportive. You know, one of the things, Mike, that was so attractive about Build America, first as an investor, for instance, if you take the state of California GOs that you could have bought with a 7.5% coupon back then, today they trade over 170 in price, an 11% return for a boring investment grade bond. But if you look at today, the opportunity on the part of the government, one of the things we've been talking about in the White House and other organizations is the possibility of a Build America type program where, in essence, this time around, the United States Treasury will subsidize 100% of the coupon. If you look at the resources of the federal government, Mike, you know that there's the discussion of a $1 trillion infrastructure program. If the federal government would just guarantee the payments or actually advance the funds for the payments of the interest for new bonds issued by state and local government, they could support $4 trillion worth of infrastructure spending with $1 trillion worth of government spending. That's a pretty amazing equation. from the standpoint of extending the resources of the government, and also partnering with state and local governments to design programs that are tailored more to the community, where they're more local and they know the needs of the local residents better than someone who sits off in Washington, D.C.
So Scott, we learned at a very young age that the best time to finance a company is when it doesn't need money, and the worst time to finance is when it does, and taking advantage of markets. And so today you see enormous amount of financing with low interest rates. On the other side of the coin, unfortunately, when people have margin calls during crisis or they're trying to get liquidity, unfortunately, they sell their best assets first. Tell us, as you've seen this opportunities unfold this year, have investors often sold their best assets?
Yes, Mike, I think that actually happened, unfortunately, one more time. And that is that prior to the corporate bond purchase program announced by the Federal Reserve, a lot of investors, as Steve pointed out, investors who are in the mortgage market were forced into liquidation of their highest quality mortgage securities at distressed prices. I think there's a lesson here for us to learn as investors and as businessmen, that liquidity and locking in liquidity when it's available is really tantamount to protecting yourself from market dislocations. One thing, Mike, you've been talking about that I actually agree with, and I think Steve's slides demonstrated incredibly well, is that for a lot of companies today that are over-levered, that there is a great opportunity to issue stock or to do exchange offers for the debt and reduce the debt on the balance sheet. When you consider how expensive debt is relative to equity, that is the prudent step to do. And I know you've been advising many people to do that. And it's, I think, a critical element, because as these businesses are becoming more and more highly levered, that they're running a risk that in the next economic downturn, they're going to face severe financial problems if they don't fix their balance sheets when they have an opportunity.
So Scott, I think, as you well know, I wrote my master thesis on this concept that if you, in a period of high interest rates or crisis, if you deleverage, your enterprise value actually goes up by doing. I'd like to turn to a name that was very close to me early in my career as an anecdotal example of something I know you really participated in, and that's Boeing. Approximately 50 years ago, airlines and aerospace companies were in serious financial difficulty. And we created a bridge and created new securities such as Airline Equipment Trust to provide that. Lockheed was probably the most extreme case where the debt traded to 15 cents on the dollar. Take us back to the financial markets and the role they played, and investors such as yourself and Lara and Steve in Boeing.
Well, it's interesting, Mike, if you look at the recent announcement of the corporate bond purchase program, at the moment that was announced, Boeing was looking for or discussing a $75 billion government bailout. Subsequently, the confidence that came about as a result of the new purchase program allowed Boeing to recapitalize themselves. So, I think that the use of the private sector here to recapitalize a lot of companies has had a really meaningful impact. But I mean, Steve, you probably have some insights here.
Thanks, Scott. It is such a virtuous circle once you fix something and you take out the tail risk, and it really feeds on each other. So you look at in the hotel sector, whether it was Marriott, whether it was Hyatt, where you could get some terrific, very low loan to values, investment grade, that were trading called 600, 700 over. And then they issued debt, so they got additional liquidity. And then they quickly, when they tightened significantly, the equities went up, and you just saw everything happen. So very good virtuous circle. And I think you see it somewhat in the cruise industry, a riskier outlook given you're not really sure when you're going to be able to sail. But I think that in general, in the leisure sector, you saw a lot of that. I think in the, I think when you're a supplier like Boeing is to an uncertain industry, or an industry where there are uncertain prospects, at least short term, you have a lot of uncertainty. And because of that, it's an opportunity. And there are a lot of examples over the past few months that had that.
Steve, I'd like to just check, in the 08-10 period, I know your firm took advantage for your clients of numerous investments in CLOs, where you were buying parts of the capital structure and annuities. Did that opportunity again, was it created again in the first half of this year?
You know what, I thought the short answer is, whenever we go shopping, you have to force rank degree of difficulty and then, upside. So I felt the degree of difficulty was a little higher in some of these CLOs, and the upside wasn't as much. So I thought something like the RMBS, where there was clear value, had more upside than what the AAA and AA CLOs had. But we participated in some, but we also saw that the underlying collateral was also a better place to look for opportunities than the actual CLOs on themselves. So for instance, the loans where you had a lot of warehouse liquidations, there were some wonderful values in loans. And if you look at the price declines in AAAs on CLOs, which is the largest component of a CLO, and contrast that with the decline in loan values, loans just went down a lot more. So that's where we saw better value when kind of looking within the market. It's one of the interesting things about CLOs today, and I mentioned this earlier about CLOs in 2008, is what's in the CLO. So CLOs will have assets of loans and then have liabilities of debt with different priorities. The assets are riskier assets today, materially riskier than what they were back in 08. The asset class is just lower rated, has more leverage, worse covenants. So that's something to take into account. And we like the asset class, but we feel like the risks we don't think are as well appreciated today as maybe there was over concern about them in 2008.
So Steve, I just want to paraphrase what you're saying for many of our viewers and listeners. Going through a few years with literally no covenants, has created, they might look the same as term loans, et cetera, but the covenants underlying them are substantially different than they were a decade ago. From a standpoint, I think that's the point you're making. That
there is one other point. They're rated lower. So if you look at the loan index, has a lower double Bs as a percentage of the index, about 10% lower, call it from 55 to 45. Contrast that with the high yield index, which has approximately 10% more double Bs. So actually, when looking at relative spreads and relative safety, loans are now more risky than bonds are, just if you look at it from a rating perspective and an absolute leverage perspective.
Thank you, Stephen. I think this is a very important element for our listeners and viewers, that there's substantial changes, and just because something is labeled the same as it was before doesn't mean it has underlying. Lara, there's another part of your firm, and that part is, more than $1 trillion in assets you're responsible for managing for people around the world. With the stock market going down $10 trillion, and on a percentage basis, dropping as fast as it's ever dropped in history, at least in the last 50 years. There had to be a lot of hand-holding. I'm sure you had margin loans outstanding to this group. Talk to us about how the firm dealt with your clients, that you were responsible for their portfolios, structuring their portfolios, and their liquidity in many cases.
Yeah, it's a great question. And I think, again, in some ways, when Switzerland went into a negative rate environment, it actually really had to change the way we thought about advising our clients. Obviously not in a crisis, but I think, the concept of being in cash really obviously didn't make sense. And I think we began to have to really reconsider the types of structured products that our clients would want. I think in the crisis, look, we obviously have a broad swath of clients in a number of different jurisdictions. We focus heavily on entrepreneurs that have public assets and private assets. I'm sure we'll get to the public and the private, i.e. non-traded, non-listed companies. And so, yes, absolutely, with the markets moving as much as they did, we had clients who we had to work with, obviously, to make margin calls. We talked earlier about were people selling the best parts of their portfolio. I think, again, many of our clients have listed and unlisted assets, so we had to work through what made the most sense for us to basically take on as additional collateral. And there were definitely days where, it was, I think, just due to the sheer volume, a pretty intense period. However, what I will say is, as we've come through this part of the crisis, at the end of the day, our clients absolutely came forward and were able to make all of those calls. We were able to bring in a significant amount of additional collateral. In some cases, obviously getting quite creative with what collateral we were willing to bring in. And I think in particular, our experience in Asia with our entrepreneurs over the last 25 years had given us a good training ground, actually, for, if you can be with your clients through these periods and you can help them either restructure what they have to be more resilient or take advantage of the markets that they're in to forward their advantage, those are the memories the clients have for the longest period of time. And I think, again, we had learned those lessons in some of the previous crises. So, I will certainly say that, many of those decisions were obviously taken at the top of the bank. But when you're in the client business and when you are certainly serving long-standing, deep relationships, and I think for a firm our size, we establish relationships with clients that we want to keep for a long term. We're not the biggest bank in the world, but we certainly have been around for over 150 years, and these are clients we select, and we hope they select us to be there over time. So we did have to get creative, and I think, though, the great thing is, as you've talked about in the last few minutes, we believe there will be a real period here of recapitalizations and restructurings. I think we expect to see cross-border activity. Many of our clients actually have looked at going private, given some of the valuations that are out there, which I think is an interesting opportunity. And again, we saw a lot of blending of private businesses and enterprises, and the effect that was having on our clients relative to some of their public advisory portfolios. Maybe the last thing I'll say is, we certainly are seeing, again, this rise in the need for very tailored advice based on not only the nature of what the client wants to invest in, but now, given the crisis, the balance between their holdings and their advisory portfolio, their assets, the businesses they're in, and their advisory portfolios. So, for us, we think actually this is a great time for our firm, because we can bring that attention, that wealth management, combined with what is deep and rich investment banking capability to these clients. We're seeing, obviously, lots of cash alternative structured products, clearly search for yield, which we've talked about already. Lots of interest in, again, as I said, potentially looking at taking companies more private, and then the big restructuring wave that we would expect to see going forward. So we like when high touch advice is needed. That's right up our alley, and I think we're going to be in that period for a long time.
Thank you, Laura. So I'd like to cover quickly this, some of these issues Laura has just raised with our group. Number one, Scott, you had actually at one time been co-chair of our global capital markets group at the Milken Institute that has about 25 trillion in assets around the world, those being insurance companies, large family offices, endowments, foundations, pension funds, and sovereign wealth funds. Many of them have actuarial assumptions. None of those assumptions can be met based on high-grade debt today or government debt today. And therefore, where are you going to structure these portfolios to generate a rate of return going forward? So that would be topic one. The public-private markets, beginning in the 1970s, after the what I would call the 1974 crisis, really in the United States, public and private markets have financed the economy. The financial institutions, the banks themselves, as all of you know, carry a very small percent of loans outstanding today on their books. And so the relative valuation between public and private, for many industries, particularly technology today, it's quite possible that public markets value a company more than private markets do. In some areas that you've touched base on, Steve, it's possible that in your experiential businesses, travel, cruise lines, hotels, restaurants, etc., that the public markets have reevaluated and they might be valuing higher than private markets. And so as you look at public-private markets, we saw a dramatic move here with private equity controlling in the United States more companies than are public today, as the companies actually in the Wilshire 5000 that changed its name, but as those companies dropped by 50%. Let's go to yourself, Scott. Compare and contrast public and private markets for us today. How are you are responsible for managing more than $250 billion. How are you going to generate a return for your insurance companies, pension funds, endowments today, and clients? And how do you see public and private markets?
Well, Mike, one of the primary things we focus on is trying to provide structured solutions to companies and public sector entities around the world. And through that mechanism, we've been able to, originate securities that have substantially better returns than those that are commonly held by most portfolios. As a matter of fact, if you look at our portfolio mix, it is only about 40% of it would be a bond that you could find in an index somewhere. But the challenge, of course, with rates being this low, even opportunities like that are becoming challenging to meet the actuarial assumptions for our pension clients, for our insurance clients. And so, of course, there's a trade-off in the minds of most insurance companies and pension funds about liquidity. And so the private markets look like an interesting place for them to go. The returns there, I believe, are not what they have been historically. I think that the private markets are more challenged. But to your point, given this arbitrage opportunity between public markets and the private markets, we're currently working on opportunities where those situations can actually be arbitraged by our clients. So that someone, if we can identify a private company that might be able to revalue itself as a public company, and the owners are perhaps wealthy families or private equity funds, which would like to have liquidity to monetize their holdings, that is that incremental jump, Mike, let's say of 20 or 30% of increased value, which you can get virtually instantaneously, it would be an incredible opportunity for people to invest in. Of course, the traditional IPO route is cumbersome. If you start to market an IPO today, you may get the opportunity to go public in 6 months, and who knows where the market will be in 6 months. So, we're trying to find ways to innovate around this so that people can actually take advantage of that price difference. But I think the last thing I would say, Mike, is, creativity has always been the go-to for me in investing. I remember being fascinated by this market for fallen angels in the late 70s. I thought that was a fantastic opportunity for people. And so, identifying those opportunities and helping to design those opportunities, I think is the great challenge that I face. And I think as investors, all of us are going to face.
So Scott, 2 follow-ups there. One, the size of the liquidity worldwide of trillions of dollars today puts pressure on you. If you get mandates where buying 5 or 10 million will not be enough really to move the needle. Can you find it in size? And number 2, as you pointed out to us, a 7.5% bond can give you an 11% compounded rate of return if it appreciates and interest rates go down. Those opportunities that you identified, are they in the same size of opportunity today that would meet a large portfolio, or are they more isolated in small dollar amounts?
Well, Mike, it's interesting. I think that they tend to be more isolated. But one of the things that we have been able to do is work closely with large investment banking firms to take away the risk of underwriting. And so in this environment, when you have situations around airlines or hospitality companies where it's really critical that deals don't fail, being very aggressive and proactive with these firms has helped us to get much larger supplies for our clients. But clearly, as rates continue to fall, as spreads continue to tighten, it's becoming more situational. But to Steve's point earlier, even in the investment grade market, only about 65% of the time have spreads relative to treasuries been tighter than they are today. So I think even the investment grade market today, along with the high yield market, still offers some opportunity near term for us to try to hit these actuarial returns. The question, of course, will be if we go through a long period of financial repression, then where will those returns come from?
So Scott, just give us a feeling. The Boeing securities, which I know you were one of the leading investors and buyers of, where do they trade today versus where did you buy them, and how long was that period of time? Steve or Scott, Scott, let's start with you on that and then go to Steve.
Well, on April 30th, that bond was issued. Mike, if you wanted to play it safe, then you would have bought the 3-year bond, which you've only gotten a return of 7% for holding since April 30th. If you had taken a little more risk and bought the 40-year bond, you would have gotten a 22% return. So that bond had a coupon of about 580, and today it came around par, and today it trades at 120. So if we could just annualize these returns, I would be the most brilliant investor that ever lived.
And Scott, just to give people a measurement, how large were those issues?
I don't know the specific sizes of each tranche, but they totaled $25 billion.
Okay, so what you're talking about is there was an opportunity to actually put some capital, considerable capital to work here.
Right.
Steve?
And I was going to say, and by the way, being proactive talking to the heads of the syndicate desk, talking to bankers on Wall Street, makes a real difference in terms of how much of this we got allocated, our firm, over $1 billion of the entire issue.
That's great.
Steve, let's talk about yourself in that you have probably operated going back and forth between public and private markets your entire
Yep.
career and trying to take advantage of that arbitrage. Laura raised this issue of public and private markets. How do they look, and what is the relative value that you see today from GoldenTree's standpoint?
So the area I want to focus on is, if you look at what's a beneficiary, that's going to have a better valuation in the equity market. So if you're Amazon or you're levered to Amazon or Netflix, that's going to get a higher valuation in the equity markets, and that's the right move or action, is to do something that's equity oriented. On the other hand, if you're at risk of being disrupted, then the debt markets are uncertain, and that's where we found a lot of interesting opportunities. Whether you look, for instance, at retail, is limited brands going to look like JCPenney? Or does Bath and Body Works more than cover your debt and then some, and Victoria's Secrets is less important? You look at something like Anglo-American, which is a large commodity company that actually did a new issue, had returns similar to Boeing. Is that going to, how they're going to be able to sell their commodities, their gold, their copper, et cetera? Is there a market for that? What was their existing liquidity? Boeing, terrific. What a great play, and what a great amount of securities to get. I mean, to get $1 billion or something up on 20 points is really unusual. I think something like Anglo-American, where there were great liquidity issues, or had a lot of liquidity and wanted just additional liquidity but didn't need it, that was another way to express that opportunity. In terms of the municipals, the municipalities, and specifically like hospitals in some municipalities, or some companies that have special purpose financing that they can get tax-free, we found some real interesting opportunities in municipals in the current environment, where there's a very interesting total return. I think American did one last week that looked interesting, for instance, where you're levered to some of their most interesting assets. And you had a tax-free shield or promoted rate. So we're seeing a lot of opportunities in some of these disrupted industries where we can cherry pick what we think are the survivors or the most likely to survive and give you convexity.
So Laura, having a relationship with a client through multiple generations, and you've raised the issue of public-private, and we've addressed it in a number of areas. But many of the clients that you advise have significant net worth in their family over generations, and many of their assets are private. And so as you sit there and look at them, and then many of those that you've taken public might be frustrated by the volatility of the public markets, particularly during March of this year. How do you see public and private markets today? And, we like to all be rational in our decision-making from that standpoint. But when you see a stock go down 50% in a month, and it's your largest holding, one, you hope your banker, Credit Suisse, is rational. And you hope your various family members are rational. Gary Becker wrote a paper, which I read in the mid-1960s and established our relationship, called Why Irrational Behavior Might Be Rational from that standpoint. How do you keep your center focus for yourself, your clients, and your focus on the public-private issues and the multi-generational issues, Laura?
Yeah, it's a great question. And I mean, the first thing I would just say generally is that, to bring it back to where we started, if we don't find a way to have more patient capital in general, we are not going to achieve the goals that we talked about at the very beginning. And, without going into all of the vagaries of some of our market dynamics, I think that that's one of the challenges that we all face is there enough patient capital out there to really invest in some of these major socioeconomic infrastructure shifts? And I think the markets have found a way to tap into patient capital, but from my perspective, it would be nice to see even more. So because some of the behavior, as you say, you're talking about, it may seem rational over a short term, but clearly, and creates great opportunities for our clients to invest. But I think if you're the owner of that company, there's the vagaries of whether or not you really have the stick-to-itiveness to do the things you need to do to grow your company long term, and where do you find that patient capital? So I think I would just make that general point. Look, I think it's definitely geographic. And it's definitely generational. So, when we look at Asia, I think you're generally still seeing, as first, second generation entrepreneurs, ultra high net worth clients who are much more focused on growing their companies, scaling their companies. There's such huge opportunity in Asia. What we generally see is there's sufficient access to capital by remaining private in many situations. And then where people have gone public, I think there is a bit of a distaste. And obviously we've got Asia has its own distinct market challenges in terms of the volatility we see there, even relative to other markets. So I think there, our clients are interested in more how they grow, how they scale, how they take advantage of that opportunity, and really being quite open to whether they're public or private. I think when you get into other parts of the world where you are 6, 7, 8 generations away from the founders, the behavior of the public markets is probably more the focus, and that's where we tend to be doing much more of what we talked earlier around creative, structured products that allow owners to, in essence, arbitrage or neutralize some of the strange effects they might be seeing in the public markets versus the private markets. So, I mean, I think from the firm's perspective, we believe that our sweet spot, again, is to be able to transcend both of these markets. We've got great relationships with our clients, a couple who are here today. We have excellent relationships with the private equity firms out there. I think we're generally known to be a key partner to them. And then coupling that with a huge, as you say, ultra high net worth client base, I do believe that we will continue to better develop that private market network in brand new ways over the coming decades, because it feels to me to be the big untapped opportunity for really bridging that very long-term view of investment in capital that so many people need, including pension funds and other things, with the benefits of having, the access to direct capital in the listed markets. So I would continue to see this as a major source of innovation over the next couple of decades for financial markets.
Well, I want to thank you for joining us today in a session that is capital markets in a time of global disruption. And it's nice to have the three of you join us as steadying the storm that we're going in. But I just want to make sure our viewers understand the enormous responsibility that you've taken on in many ways, Laura, keeping capital markets open at your firm, but also in managing the money, particularly for those foundations, endowments, pension funds, in addition to family offices that sustain and are often the supporters during the most difficult period. Scott, I want to ask you one question in closing. That's a short answer. The time of government response Uh, Compare and contrast it to 2008 and 2010. Is it faster today than it was then? Is it slower? Scott, what's your response?
Well, the short answer is it's been much faster, Mike. And the government response was behind the curve in the last crisis. I would say the government so far has managed to stay ahead of the curve, the Federal Reserve, Congress. And the question is, going forward over the coming months, will the fiscal side of the house be able to keep up with the needs, which we're going to have to address? I'm optimistic they will.
Well, thank you, Scott. Thank you, Laura. Thank you, Steve.
Thank you.
Best of
Thank
luck
you.
and good health to all of you.
Thank you, Mike. We hope to see you soon in person.
Hope to see you soon in person. Thank you.
Guys.